Hey, tonight's special guest, Eric the Wolfman Wilkinson, a fellow floor trader from Chicago and a fellow Chicagoan. Let's bring him out and meet him. I'm Lex, and this is Options Brew TV. Hey, tell us a bit about what you do now relative to what the folks can hope to gain. Meaning, tell us about your website, your teaching, your mentoring. Where can people go for that? What sort of things you teach generally, and then I think you're going to get into some specific examples and share some screens. Is that right?
Yeah, that's what I'm going to be doing today.
Okay.
So I actually started out trading in college. I bought some stocks. One of them was IBM, another one was Walmart, and the stocks just didn't go anywhere. That's where I started getting involved in options, and then decided, hey, this is what I want to do for a living, and moved to Chicago to work on the floor. So during that time, I've traded options, futures. I say I'm a recovering futures trader now. And trying to stick with options and more of the longer term, maybe swing trade from the day trade kind of thing.
Right.
But in that, on the floor, Lex, as you know, we had to think quick. You didn't have a second or two to answer, because it was usually the first person that spoke was the person that got the order. So you had to streamline your process in order to get your pricing, in order to make your decisions.
Right.
And that's exactly what I've tried to translate to people, is how to streamline that process. There's a lot going on with options, and a lot of it is just noise that you don't necessarily have to look at. So what I try to do is get people to focus on some of the key aspects of these options and the Greeks. I don't want everybody to run away and say, oh my God, he's going to be talking about Greeks all the time. Right. But, on the floor, we had the same Greeks, and in order to remember those easily as a newer trader, I think I've come up with some ways that even your students or people that are trying to learn options can relate to then, rather than just kind of looking at a Greek and saying, what is delta and why is that always on there, or gamma, and so we'll talk about a few of those things, and I'll try and drill down on that, give people a little bit insight into the ways that I learned options.
Okay, good.
Trying to pass
good. On. So it sounds like, maybe a little bit, correct me if I'm wrong, you're taking a lot of your floor experience, right, from your trading days, and you've translated into a nice package and understandable for students in what I call the off floor. Now, off floor to me means everything that's not on floor. So that was a tough transition. I got to tell you, for me to get off floor and learn how to trade without being in the pit and hearing the order flow and seeing it, it was
and feeling it, right?
And feeling it. Yeah, it was different.
There was a feel to that floor. Like you'd be standing there and not even think anything's going on, and the hairs on your arms would start standing up. Right. You're like, what's going on? Like, where's this energy coming from? Oh. And then all of a sudden you'd get like an uproar or something like that,
No, that's good. So, and to be clear, do you teach all levels of skill in options in your wolfmanoptions.com?
Yeah, actually, even in each course that I do, I try to make it where somebody has something to take away. Even if, this, I always say, even the savviest of traders is going to learn a thing or two, Right. And that just comes from, being in the thick of it, trading options. And we had mentors, when you were in the pit, everybody was around us and you were held accountable, really. I mean, sure. Yeah, the guy right next to you wanted to steal your money, but sometimes if you did something stupid, the guy would kind of look at you and you're like, okay, yeah. Right. But when you're in your office all by yourself, you don't have that accountability all the time. Right. So what I try to also teach is, hey, stay mechanical. If you start letting fear come into it, or doubts and all of those things, that's where you're going to start making mistakes, or you're going to trade too much. Right. So I try to give some finite examples of, for instance, on say a short put for a bullish directional assumption, on something like that, I would say, get out at like 75 or 50% of your max profit. The collection is your full credit. Sure. That's your max profit. Well, get out before that, because you've beaten the probabilities. There's no reason to ride options into the sunset, as far as I'm concerned.
Yeah.
So
Yeah.
I try to
Yeah.
keep people from avoiding those kind of mistakes.
Got it. I don't know if you had the same terminology, but in our business was teenies were meant for buying, not for
Yeah,
leaving short out there, right? The teenies a 16th back in the day when we had fractions. We don't talk in fractions anymore. We're talking
I know.
decimals now, but pennies. Let's call them pennies.
Right. Well, you know, you probably heard this one too, you know, bulls and bears make money, but pigs get slaughtered, right?
Absolutely.
So that's my
100%.
thing is like, if you're trying to get an extra dime or a nickel out of your option, you know, you're kind of being a pig.
Yeah, absolutely. Good. Okay. Well, let's look at some things. What do you say? I think you
Yeah.
know how to share a screen. Let's go through a few things and we'll have some questions and see where we go.
Yeah, absolutely. So, you know, a lot of people, when they're thinking of the covered call strategy, they are thinking that the only way that you can really, you know, be successful with a covered call strategy is to have a stock that's literally trading sideways, kind of like this.
Mm-hmm.
And yeah, that looks pretty easy. You can get into a covered call strategy. It rarely gets above a certain level. And a lot of people will gravitate towards this for a covered call. And let me tell you, like I said before when we were talking, this is a stock that got me involved in trading options. And it was specifically on covered calls because I was so annoyed that the stock would not go anywhere. And back in the day when I was trading options, it was trading right around here between 100 and 115. Sometimes it would dip down to 90. And it seems like we haven't gone anywhere in the last 20 years.
This is IBM, right?
This is IBM. Yeah.
Okay.
So we've got IBM here.
Yep.
So when it trades in a tight range, this is a great opportunity to start getting your feet wet with trading options and more specifically with selling options.
Mm-hmm.
And a lot of people are a little nervous about the, you know, collection, you know, the risk involved in selling options. But when you own the stock, which is with a covered call strategy, you
Mm-hmm.
would own this stock in your portfolio. And the idea is just to sell some covered calls. We'll talk about the specific strike locations and things of that nature to
Mm-hmm.
really streamline your folks' process. But at the end of the day, what we're trying to do is lower our overall cost basis. Maybe you could look at it as an extra income stream rather than just getting that dividend. You can actually get another collection of credit. Mm-hmm. I like to look at it as lowering what I paid for this because ultimately I'd like to try and get it down to zero if that's at all possible. That's always the goal here. And if it gets called away from me, then I would just go into the, you know, cash secured puts kind of strategy where then I'm selling cash secured puts at a level I'm comfortable buying it and continue to collect that credit, even though I don't own the underlying, but try to get it back.
Let's step back.
Right now, I want to specifically drill down on.
Go ahead. I'm sorry. I apologize, Eric. Go ahead. Finish up.
But I want to drill down on the covered call strategy. I got a couple of them. This is a great one. Like I said, I got started trading options around this type of strategy, but we do need to know a couple of things before we get in there. And yeah, it's going to be the Greeks. Okay. And Delta, you're going to see this in the option montage. That's where all of the pricing is and the strike locations and stuff like that. I'll pull up a screenshot of that in a minute.
Sure.
But Delta, it affects the options premium. But what we used to say on the floor was it's data. And that's almost more important than how it's affecting your premiums as far as I'm concerned. But the data, what we would say about this is delta equals data, and that also equals your probabilities.
Right.
Right?
Yep.
If I can.
Boy, you're good at typing, writing on there. Holy.
Well, I got a Wacom pin tab.
Oh, I love it.
It's on the floor.
I need one of those.
When we started going from my transition from the floor to the screen, started with this big Wacom here that I paid like $4,000 for, so I could write with a pen on my trading screen and hit it. As a matter of fact, there's a picture back there in the background, and that's when Drew Barrymore came on the floor, and I had her put in a trade for me, and I made it sound like it was a mistake, and she they snapped the picture as she threw her hands up, and I was like, no.
That's awesome.
So Delta's really just the probabilities, and that's what we're most concerned about when we're selling this covered call strategy. Is they get into a strike location where you have a low probability of having that stock called away from you, but at the same time you get a nice little credit for it. So it's adding as a nice little dividend. And what I like to go for is this is a regular standard deviation curve. And some of your savvy traders are going to be like, well, standard deviation curves never look like that. They kind of look like that, or they're a little skewed. I don't want to, beat that horse right now. But right now, what I want to talk about is the one standard deviation. And if we think about this as being the calls and this as being the puts, one standard deviation to the upside really is correlating to our option montage. All of these numbers will add up to what our probabilities are, or our deltas. So when we're looking at a 16 delta,
Yep.
you know, if we look at the probabilities of it landing outside of this, we need to add up all of these numbers, and it comes up very close to 16 delta.
Okay.
Or a 16% probability of any of this happening this way,
Sure.
right? And that means that there's an 84% probability of this happening. So your probabilities of your strike being called away from you are relatively small. And the beauty in this 16 delta is you will get a nice credit still. You start getting out to like the 10 delta, the 5 delta, which is really far out there. Your risk reward, meaning the risk of it getting called away from you, is very small, but your reward is also small. So
Sure.
you're not really benefiting a whole lot from getting way out of the money on these calls.
Sure.
So
Let
I
me
like
ask
to
a
go
question.
with that 16 delta.
Yep.
Some people talk about the 35, 36-ish delta. That's about a half a standard deviation. That's going to be really aggressive.
Okay.
You know, maybe some of your savvier traders see a topping pattern and think
Sure.
there's going to be a pullback. That might be the time to go for that 36 delta. But for most traders, I would say the sweet spot is this 16 delta because of the low probability of it going in the money and the amount of premium you're going to be able to collect from that.
All right, let me jump in a sec, Eric.
Yeah, I'll go back there.
Yep. So I get the 16 delta, understand that. I get all the math here. That works great. What about for the viewers? What about the term? How far out are we looking for the 16 delta? Are you going to come to that story in a second?
I will talk about that. As a
Okay.
matter of fact, I'm getting ready to jump into that.
I'm reading your mind then. Let's go.
You're all over it. You're following my slides on the background somehow.
I love it. Go ahead.
So, we want to take advantage of that strike location, but we also theta. You just mentioned it. And
Okay.
we used to call this the thief. This is the thief in the night that comes and steals your premiums, right? So every single night, theta comes in and picks your pocket. Sometimes you want him on your side, like if you're selling a call, right? If you sell high and buy low with this covered call strategy, well, then you want to take advantage of somebody picking away at that premium, right? So what we try to do is get out on the time horizon. Hold on, let me slide. I think I got my slide out of order here.
That's okay.
Sure that I've got it. All right. I guess I'm not having it. All right. So theta is the thief in the night that comes and steals our premiums. And we can see that theta. Oh, sorry. I got my pen backwards.
Okay.
I got my eraser on there. So we can see this theta component over here. And you can see that theta is always negative, meaning you can't stop it, right?
Right.
The assumption with the Greeks is you go a day further, you move higher in the underlying, the volatility goes higher. They never really talk about it moving backwards. And that's because it's not intuitive, I guess.
Sure.
But with theta, you're always moving forward, and that theta is always eating away or eroding your premiums. And you can see that he is more aggressive the closer to expiration. We get into 2 days to expiration, you can see that it is a much bigger number than 35 days. So inside of this, 35 days to expiration is the real sweet spot for taking advantage of theta. And I had a chart here that for some reason it looks like I hit it.
So you're saying, Eric, you're saying, I want to make sure I heard that right. Within 35 days and closer, that's our honey zone for these plays. Yeah.
Yes. The sweet spot is really, let me see if I can unhide this.
Okay.
I don't know why I accidentally hid this.
And while you're doing that, let me make a clarification point on the negative sign in front of theta. So the negative sign, what that does, remember, a negative times a negative is a positive, viewers. So if you are short these options and you multiply that negative theta by your negative option, it's going to be a positive number. And that theta, as Eric described, is the thief. It's a benefit to you in terms of what we call decay. So that crumpling of premium when you're short those options works in your behalf. And I hope that makes sense, right?
Yes, absolutely. So, for instance, to your example, if you were looking at, let's just say this call right here, and this isn't necessarily a strike location I would look at, but, tomorrow, if all else equal, this underlying, we can call it XYZ, all right? Because I blocked it out on purpose, so I don't want to get anybody thinking it was a specific underlying, because this is pretty consistent across the board. And we could see that tomorrow we would wake up and these premiums would decay by that 13 cents. Whereas further out, you know, this is only going to decay by this 5 cents across there. And then you get out like 90 days, it's only a couple of pennies every single day that's going to come out of it.
Right.
So we want to take advantage of theta getting more and more aggressive. And I like to say that that 35 days to expiration is the real sweet spot, because I got my chart. You can see that if you drew this line out, it would kind of flatten out. So if you're in a buy zone, this would kind of be where you would be thinking you would want to buy, because you're limiting that theta decay. If I want to sell something, I want to be inside of this, because we can see inside of 35 days to expiration, we have almost 50% reduction in our premium only due to theta. So if everything else remained the same, the underlying didn't move a penny, well, we would see our premiums reduced by 50% over the next basic 21 days or 20 some odd days.
Right. And then, and for the viewers, then the takeaway here too, I want to make a note of this. Notice this graph that Eric put up. This is a great graph about theta. It is not linear. So it is not linear at all. What I mean by that, it doesn't decay equally over time. The closer you get to expiration in his picture here, the more this thing starts falling off the cliff. Look at day 7 and below. It's steep, right?
Yeah.
It's steep. So it's something you really have to pay attention to, right? Good point, Eric. I appreciate that. That's good.
And one of the things with this, though, to note, a lot of viewers might start thinking, well, why aren't I just selling inside of 7 days to go? Well, your premiums are almost gone at that point. You're going to be very close to where the underlying is. So for me, I would like to play in this area, get in and out of these options. Like I said, maybe it was before we started talking, I don't ride options into the sunset. I want to get in and out of these as quickly as I can in order to, you know, keep making those. I swing for singles, doubles, and triples, right? I'm not swinging for a home run. Too many things you have a lot of things that I'm not going to talk about in this webinar, but gamma risk and all of those things that is really going to affect your premiums. I try to stay away from that. Now, I do have an example that we're going to be talking about today where I am writing it into very close to the end of the day, because I'm really close to having a stock called away from me. So it's a bit tentative. I try to stay away from that if at all possible, though, when I'm trading.
So that 28-day zone is our honey zone, right? That's what we're looking for.
Yeah, I want to be right in and out. 7 days to go. I would love to be out of here. You know, if I can be out of that area, I will. But, you know, again, sometimes it's going to be very close and touch and go with it. And we'll talk about that example here in a minute. But,
okay, perfect. Good. Totally understood so far. Great.
Perfect. So like I said, we're going to be doing the covered call strategy. I'm going to show an example here of IBM. And when it's trading in a sideways market, like we said, you know, you can kind of even if I didn't have Fibonacci's, anybody can kind of look at that and say, that's really where it wants to be, right?
Sure.
So you've got a pretty good idea of where you want to sell your calls, and if they get called away from you, where you can sell some puts and continue that cycle over time. So it's going to be a journey, folks. I mean, if you look at my trading history, or not my trading history, this is a hypothetical trading history, folks. But you can see you are going to be in and out of this, staying mechanical. You're staying with it. It keeps you involved in the market. And beauty in this is, you know, people might be like, hey, dude, you're really on top of this. You know, I don't know if I have enough time to do this. And this really is set up on I get my stuff done early in the morning, put those orders in, and then let them go and get canceled if not. But ultimately, you know, you can see the order fills was only 12 on this trade. So throughout that time, I was able to lower my overall cost basis on this quite dramatically. So you can see I zoomed in on the chart here, and I got involved in this by selling 120 puts on the weeklies for an earnings. And earnings don't always work out. I mean, especially, I should have known. I mean, IBM, I've been trading this for 20 years. Wall Street hates IBM's earnings. I mean, if you could almost guarantee anything, it would be buy after the day after earnings. Right. Even if it's great earnings, they just hate it that they're going into the cloud, and that's high margin as far as I'm concerned. That's why I love them. But anyway, you can see I got hit on this 120 put on the earnings. It dropped down. Well, I started getting very aggressive and mechanical with this. I thought, all right, well, I'm going to need a dollar cost average on this. So I'm going to look to sell the 1.0 puts. A couple of days later, I wanted to take advantage of those premiums that were still pumped up from the earnings. They were still a little bit frothy there. So I was able to take advantage of some nice premiums there. And I'll talk about volatility and stuff, how we can take advantage of that also. But so I did a little dollar cost averaging. You can see I sold these 105 puts for $1. 2 days later, volatility actually started spiking here. And I was able to sell these 120 calls. I thought, you know what, if it starts rallying up there, I can offset my puts with my calls there, collected a credit on the 105 puts, all of those things, just trying to lower the overall cost basis. Bought them back for a nickel and a dime on just a sideways market. And this was literally, you can see that we just went sideways. It was a little bit of theta decay because I got inside that sweet spot inside of 35 days to expiration to try and take advantage of it. As you can see, they're no, so they're expiring right in here. And so I was able to take advantage of that, but the volatility coming out was what really helped me with this trade. And I was long IBM at 120. Having said that, I've lowered my overall cost basis on this trade by about $1.40-ish so far. So yeah, I'm still underwater a little bit, but you know, when you're staying mechanical with these trades and you feel them going against you and you have a covered call on, it doesn't feel so bad. It's kind of like, you know what, I'm making money on those covered calls and I expect a correction, right?
Okay. Let me ask you a question, Eric. So just so for some clarity here. So you got assigned on the 120 put, is that correct?
Yeah, I got assigned on this weekly 120 put.
Okay, so now you're long stock, and then did you also sell the 105 put, and you're not afraid to be long a little more stock if needed?
Well, and you know, obviously what I would say when you're getting involved in these types of strategies, especially trading, you know, puts and calls from the sell side, you shouldn't be doing this any more than you would normally be doing with a regular stock. If you were going to buy 100 stock, you know, you only want to be doing one lots of the options because each option is equivalent to 100 of that underlying.
Perfect. Yeah. Good.
And so like a lot of people will get involved in options and they start selling like 10 lots and they don't really realize, okay, that's 1,000 of that underlying.
Sure.
So you don't want to get in these trading ideas without the idea that, hey, I might have to actually own this stock or sell this stock, right? So only do as much as you would normally do with a regular stock.
Perfect.
Is what I would say.
Okay.
And yes, I was doubling down on this, but it would have, if I would have gotten those 105 puts, I would have been heavily weighted. All right. And it would probably been more than what I would have normally allocated towards one stock in this sector. Right.
Okay.
But I was willing to take that risk and buy those extra. I had the money in my account. I knew I was, you know, it would have been a full tranche if I would have gotten those 105 puts. But at the end of the day, you know, I would have been comfortable owning all of that stock. You know, especially when you see where IBM trades like that, right?
Right.
So yes, I was willing to add on to that, but I didn't get super aggressive at the onstart, right? I didn't go full boat on this.
Sure.
And I don't ever on any of my earnings trades. I look at each trade.
Scale in, right? Sorry, Eric. You kind of scale in. You don't use all the gunpowder in one shot.
Yeah, you know, and as much as people say that they know the directionality, nobody knows.
No one knows.
You know, so that's why I try to play the probabilities, right? And volatility on these was, you know, starting to spike. 105 was a pretty good level for me. I thought that, you know, the Fibonacci was nice on that 23. I was like, hey, you know, it goes below that. IBM in, you know, double digits is kind of ridiculous, really, but especially with the earnings that they were coming out with. And I covered those, you know, and then selling, just staying mechanical with it. I get in and get out, you know, you're trading sideways, get in and out of them. I don't always, another thing is a lot of people will do rolls where they absolutely, you know, I'm getting out of one covered call strategy, covered call at a strike, rolling it out and up in time and staying like that. You know, for instance, rolling it from the D's to the Jan. I like to take advantage of when the market sells off, that's when I'm covering my calls. You know, it keeps
Okay.
your powder dry on this long stock. And then when it rips, if you get a nice big rip, that's usually when I'm looking to sell it. I'm not always looking for chart setups. I'm just looking for, like, on this day, you know, I got 2 nice big days up and I was like, hey, that is a pretty strong move on nothing.
Sure.
And decided to go in there and sell some calls on the rip, and then buy it when you get that little bit of a pullback.
Right. So will you ever, let's say I'm going to draw on the screen myself, if that's okay.
Yeah, please.
So if you're into the long side here, and let's assume you didn't get assigned on the 105 put, you just have the 120.
I didn't get assigned on that.
Okay. So let's say you were able to make a little money on both of these, the call and the put here, but what you did there, right? So now I think you're just long the stock still, and you're ready to sell another call, correct?
Yeah.
If you get this rip on these 2 candles, do you ever say, you know, that's pretty good relative to something, relative to the chart? Do you ever just sell out of your stock and be done and kind of wipe your hands a little bit and maybe play another day? Or you're always in motion in this stock? Does that make sense, that question?
Yeah, absolutely. And you know, a lot of that really is going to be on you know, my gut feeling, to be quite honest. Like, how do I feel about this stock? You know, IBM, I'm pretty comfortable with IBM because it's just going to trade sideways. Now, I do have another example where I've been very nervous that I didn't want to get it called away, and I was playing this strategy with it. But, you know, at the end of the day, I'm going to look for it to get called away from me in a stock like IBM.
Okay.
But yes, if it starts really rallying and I don't want to lose that stock, maybe you don't want to pay capital gains tax on it and stuff like that.
Sure.
Then yeah, get out of that covered call. Sometimes you're going to lose money on it. And then just continue to play that game, move it out, wait for your opportunity.
Sure.
And do the covered call strategy. But ultimately, if you're looking at this 16 delta, like I've been doing, or that I teach, to go and get that 16 delta or as close to it as you can. Lex, you know that there's not always a 16 delta, but I'm looking for that 16-ish delta. Sometimes it's a 15, sometimes it's a 14, sometimes it's an 18. But right around that is what I'm looking for.
Got it.
For a strike location, and try to hone in on that. And as you can see, I'm getting different premiums for them across the board. 70. I don't really care about that as much as getting in and out of it. And you can see that I'm always covering these when I get the opportunity. Like I'm not writing those in for those last 7-8 days to expiration to get that last dime. I mean, yeah, it's $100, but at the end of the day, I don't care about lowering my overall cost basis by that extra 10 cents.
Sure.
It's not really worth it for me. So I'm trying to get in and out of these when I have the opportunity. Any kind of big pullback is where I'll even possibly pay up to get out.
Sure.
And then just, you get another rip, you could end up selling those same strikes again in the same month. You don't even always have to go out in time. And I'll show you an example of that as well, where I intraday traded some of these short covered calls on a stock.
Yeah. Let me ask a question while you're thinking about that next point. So I think you mentioned earlier in your talk here, you like to grab about 50-75% of the premium of your short as a kind of a target to close that option out. Is that what you said? I want to make sure I heard that right.
You did hear that correctly. And that is specifically on, when I'm doing a trade for like a bullish move. So if I were going to teach, how to sell puts, all right.
Okay.
On a trade like that, I have different rules than I would have for like a covered call. Because with a covered call, I don't really care about volatility.
Sure.
But if I'm selling a put or just selling a call for a directional move, then I am hyper focused on what volatility is, because that affects the premiums, right? The higher the volatility, then the more premium you can get.
Sure.
For that same strike at any other given time. So you can also get further away and things of that nature. So on those types of trades, those types of swing trades for a short call, a short put, then I'm looking at 50-75% of my max profit. On a covered call strategy, I'm usually looking to get out at around a dime or a nickel. And a lot of times I'll leave in GTC orders to get filled like that.
Got it. Okay. Understood. I get it. Perfect.
So this is a little bit different from a swing trade that way, but I do have specific rules and guidelines for selling options specifically in call spreads, collection of credit and stuff like that too. But
Yep.
all right. So this is another example. Now this is almost a 45-degree angle. All right. We're talking pin.
Yeah.
In 1 year, I mean, we are literally 1 year away from that low. Tomorrow, I think, is the 18th was that low.
Okay.
And going from $3.75 to $142. Now, most people would think that how could you possibly do a covered call strategy around this? But if you're picking that 16 delta, and I wouldn't say do it, on a pullback, but after rips, that's when you want to sell these covered calls and look for that 16 delta.
Yep.
And as you can see, so if we think hypothetically that we bought this pin trade at 449, well, it's hard to sell covered calls on anything less than probably $50, to be quite honest. So
that's right.
It's better to use this with stocks over $50 and even over $100 is really where selling covered calls works the best, in my opinion. So you can see you would want to wait till you get above that $50 level and you start selling calls against it. And you can see this is a pretty strong move to the upside. You sell covered calls there, sell the rips, buy the dips. In this covered call here, you got this topping pattern confirmation. You would have thought that it was going to roll over, but obviously it didn't. And traded sideways, took advantage of that theta decay. You can see options would have expired right here. So just before that 7 days to expiration, I'm looking to get out and, looking to get out for 15 cents. Now, this was where I sold these D's 90 calls, and you can see it just started rocketing up. Right. But in that time, I decided to cover it because I thought it was going to get called away. It was really close.
Sure.
And I got out, but I still was able to get out for a profit, right?
Okay.
30 or 25 cents there. So even though I was completely directionally wrong there and got that rip on me, I was still able to get out for at least a little bit of a profit. Right. And that was getting close to getting it called away from me. And, or one would think that it was going to get called away from you, and just got out for a small little profit on that.
Got it.
And
so
then again, sell the rips in the January, and then, buy this dip. So I got in right here. You can see I got out almost at the same place.
Sure.
Again, we're taking advantage of that theta decay. We're taking advantage of volatility, all of those things working in our favor, and was able to get out for, again, a profit there. All in all, this total collection, oh, right here, I wanted to mention this one. This was right here. I got out of these. This was the real moment that I was doing a webinar on this, actually. Yep. And this marked this stock where I lowered the overall cost basis on it to less than what I paid for it. So it was a negative 10-cent credit on cost basis. So when you're selling these calls all of these times, and I look at it as, all right, well, now I've just dwindled it down, subtract that 122 from the 449. Now my cost basis is a little bit lower. My break even is lower, right? Some people could look at it as like you're getting an extra dividend, which, PIN doesn't pay a dividend, and that works too. But I like looking at it as lowering my cost basis to zero on a stock, like I said. And with that being said, so I bought those in just to make that milestone of owning PIN for free. But then the volatility started spiking. This is actually supposed to be a sell. And intraday, I sold the 170 calls here. Where is it? Right here, 170 calls. So I got a little aggressive there. Sold the 170 calls. Right. And actually, this was the 170 calls was where I actually went to where it was positive. That 36 cents.
Oh, I got you. Okay.
That's my intraday. I covered the calls here. That got me to about 20 cents or whatever. And then I said, you know what? I'm gonna volatility started spiking. I was able to move out and higher in time. So collected another $1.26. Market free fell, and literally what was it? Not too much longer later, I was able to get out of those for a profit.
Oh, nice.
On that. And then I am currently, or we're hypothetically short the 190 calls in that. Today,
So
they
you're
made a big comeback. I was trying to, or looking to get out of those today.
so
It never got down
hypothetically
to
you have your whatever number of shares you have versus an equal number of short calls, right?
yes.
That's what
And you don't always have to do that. You can do it as a ratio. I like to do it 1-to-1. So for every 100 underlying I'm long, I do one option contract. I like to keep that 1-to-1 just to keep it straight in my head and lowering cost basis and all those things. But if you're long 1,000 of some stock and you want to just do 5 of them,
sure,
absolutely. I mean, there was no way I would ever say don't do that.
right.
I usually will stick to that 1-to-1
Sure.
type of trading
Let me
regimen.
clarify one other thing too, because you and I like to talk trader talk a little bit. So you mentioned that you could get called away, and I just want to clarify what that means. So when Eric says he's long, let's just go with 100 shares in one option. What could be fearful is that if the option expires in the money, that means the stock, in a call instance, the stock is higher than the strike price you're short at expiration time. That short call will expire into short stock and they will net each other out and you are left with zero. It's called away in his example. Right?
Absolutely.
So in the other example, if you're long 1,000 shares and only short 5 calls, that's like 500 shares. You're never getting fully called away. You're only getting partially called away in that example. Okay.
Absolutely.
So I just want to make sure the some of the beginner viewers understand that point. That's what Eric's referring to when he talks like that. Okay, good.
Absolutely. And you have 1,000 shares, that gives you a lot of room to play around with this. You could even do different, maybe sell a 30, a tighter strike and then further away, all of those fun things.
Cool.
But ultimately, like you said, if my underlying rally is above my short call, it will get called away from me at my strike price.
That's right.
So even though the underlying is trading 150, if I'm short the 120 calls, I am getting out at 120. All right. So you're getting called away there. Right. Ultimately, that's where I start going in and immediately selling puts to try and buy that back at a level I'm comfortable with.
Sure. Okay. Understood. Great.
Not $3. I don't think I'm getting a $3 put for.
You never know. GME, you might.
Yeah. You talk about call skew. Have you talked about call skew? That's like the quintessential perfect example of call skew.
Yeah, I know. I saw it.
You could sell like I don't know where it's even trading. I took a screenshot of it because I think at some point in time in my life, that's going to be a great example of call skew for sure.
Oh yeah, it is. Oh, well, that's a whole other story. GME. I've done a lot of webinars on GME lately. So
right. So your guys at Tradier are probably savvier traders, but you probably have some newer traders that are getting interested in options. Like I said, this is a great strategy to start getting your feet wet, collecting a premium, taking that risk, and then selling cash secured puts if it gets called away from you. And all of that kind of will increase your risk tolerance, if you will, where it's just a way to get involved in trading options. We're all trying to grow as traders, right? Sure. And that means taking on a little bit more risk here and there.
Yep.
And growing that way. So ultimately, this is a great way to start getting involved if you're comfortable trading options from the call side buying or the put side buying to take advantage of those directional moves. This is a great way to, in my opinion, to start getting involved in selling options, collecting that premium, and taking a little bit more risk. So
awesome.
And with that said, another thing we could do is look at this with a Home Depot trade. And Home Depot, I did a webinar on poor man's covered call. And if you're not familiar with a poor man's covered call, literally what you're doing is you're just buying an in the money call, where I'm buying a call below where the underlying is trading, and then selling a covered call against that. So during this time, when I'm building this strategy out, this 110 call here was in the money. And then I'm just selling calls as we go along to lower that overall cost basis. As a matter of fact, I got out of this trade today. I finally traded out of my 110 calls for that.
Yeah. So here, let me point it. So Eric is referring to the 210 call there. And I think you said the 110, but it's a 210 call, right?
Oh, sorry. Yeah. 210.
Yeah. So the viewers, look at the price of the 210 call. It's a $56 option. Okay. So what he's doing is it's sort of like a facsimile for the stock is what he's doing. And it costs you that $56, not $210 to own that. Right. So it's a
Right.
that's why he refers to it as a poor man's covered call, is because owning one lot of those is way cheaper than owning 100 shares of that $210. I should say it's a bigger stock than that, right? Where is it?
Absolutely. Yeah. So I think it was trading, this was
270
trading
something.
around 265 or something when I bought it.
Yeah. So it's a much different margin requirement when you do something, when you buy the stock versus owning that deeper in the money call, as he's referring to here. So that's a clever way to do it. I like that.
Yeah. And the beauty in this is if you were to go out there and just buy Home Depot, like you were mentioning, say you bought 100 Home Depot and then you did a covered call against it.
Yep.
Well, your risk on Home Depot now is to zero. If
Sure.
Home Depot goes bankrupt, now not to say that it is, but if it goes to zero, your risk is to zero.
Mhm.
Whereas my risk in this poor man's covered call strategy is only to 210. I have
Right.
no more risk below 210.
Right.
So it's really got a synthetic put added into it with this strategy. So,
Sure.
For newer traders, people that are struggling with margin in their trading accounts,
Mhm.
Again, using options to use that leverage in a sense,
Yep.
it makes a lot of sense, right?
Yeah, no, it does. It's a good point. And just mathematically, just for numbers, I just cranked it on the calculator. Let's say it's $250 you bought the stock. That's $25,000 on 100 shares.
Yeah.
That is the price of that. Okay. That's what you got to come up with. And then that $56 option on the same one lot is $5,665 in his case, in Eric's case.
Right.
Hypothetical.
Because it's equivalent to 100 of that underlying.
That's right. So it costs
by
you
100.
$5,600 to do the poor man's version versus 25,000. That's an easy difference to understand. I don't care how much you know about options. That one's easy to understand. Right.
Yeah.
Good.
Yeah.
Great example.
Yeah. So, and you're limiting your risk to the downside.
That's another great point. Yep. Absolutely. Yeah. Very important. Good.
Yeah. And that's about it. I mean, those are my three examples. We can do one with just options, doing a poor man's covered call. And I have specific rules around stuff like this. Ultimately selling this call lowers my overall cost basis to where the underlying was trading at that time. So if we think about, you have to add the 210 plus the actually 54.67.
Sure.
So 64.67 is where I got long.
That's right. Yep.
And then I had no risk, below 210.
Yep.
I'm out.
You're out. That's correct. Good. That's awesome. Yeah. And so that's a great way to take advantage of it. And this is the sort of stuff that you teach I don't want to say the class, but is that the right word, in the class?
Yeah, I do different courses. So I'll spend like an hour on a specific strategy, kind of like what we did here with the covered call. But for some other ones, what we do is we try to create a roadmap for people. You come up with your directional assumption, whether it's bullish or bearish or market neutral. And then we start looking at what is volatility doing, because if volatility is extremely high, we know those premiums are elevated.
Sure.
And my teaching, or the way that I trade, is, you sell the rips and you buy the dips.
Sure.
Really is what it amounts to. So if the market is, or if volatility is, spiking, you got to start thinking about selling premiums for any types of directional assumption. When premium is super cheap or that volatility is really low, that's when we need to think about buying it. And I also have really easy ways to figure out where volatility is in relation to where this underlying, has seen it before.
Okay, good. And do you have a couple slides on your website, or should I put that in the video when we?
Yeah, you can do it in the video, but we're going to give you guys this one for earnings with options. Now, this goes through about 10 or 15 different strategies I like to use around earnings, specific rules, when, where, and why we would be doing these strategies. Sure. Also setting up, and a lot of people might be going, hey, we were just out of earnings. We just missed that. I can't take advantage of this. Well, it's also setting up for the next earnings. We're going to be taking advantage of volatility expanding around those earnings coming up down the road. So I show all kinds of different ways to take advantage of that as well. So
Good. Okay, good. And then so protraderstrategies.com, right?
protraderstrategies.com and /options course, earning with options.
Great. And they can get a lot of information off your website, I'm sure, right?
Yes, they can. And wolfmanoptions.com, you can get all kinds of background videos and stuff like that as well.
Okay. Eric, that's great. I really appreciate you coming on. This is awesome. Great stuff. So much to learn. My goodness. It's amazing. And you know, I can't stress enough, you have a way of doing things and you're probably very disciplined. And I always talk to folks about being disciplined. Learn your strategy and stick to it and be disciplined, right? That's how you.
Absolutely. You know, I kind of look at it, be disciplined, be mechanical. Like if you can take the emotion out of trading, then you will be a much better trader.
Absolutely.
And to that point, not think about it as money. You think about it as probabilities, right? Then that changes your thought process, right? If you know you're doing a 16 delta, I only have a 16% probability of being in the money. Well, then at the end of all of that, that I can live with that. Yeah, it's up there. It's kind of like with my IBM trade that I kind of breezed over. You know, I am short the 130 calls in IBM today. I think it's settled 129.
Right.
You know, but I'm still playing those probabilities. I think it's going to settle out of the money. I'm still playing that one out.
Yeah, that's great. All right, great. Well, thanks for coming on and doing this. We'll post this baby probably the next day or so.
Okay.
And that's how it goes.
Perfect.